Hey, what's going on, traders? My name is Bennett Tyndall with TradingAnalysis.com. Thank you once again for tuning in. Today is Thursday, June 11th, 2020, and as you can see, the markets are moving lower. We currently have the S&P 500 down 5.9%, NASDAQ 100 down 4.87%. But traders, investors, if you guys have been following our Elliot Wave Wednesday live stream that we host for free every week, 8:45 Eastern on Todd Gordon's YouTube channel, you'll know that we've been anticipating this near-term corrective move. As a matter of fact, let's take a quick step back. We're going to go to the May 20th stream. We're going to take a quick look at a clip where we were reviewing the S&P 500 chart, and I want you guys to note the fifth wave target that we had lined up going into this wave one of a higher degree top. Gold at least. So, you know, we've got this situation where everybody who kind of sold into that low and is now sitting on a lot of cash, I think they're still a little bit undecided in the kind of outlook for the market, right? Like guidance for the next couple of quarters, you know, discount rates, earnings, even, you know, you take a look at Apple suspended guidance going into the next quarter. So I think although we do have this significant outperformance of the kind of key weighted names, especially in the NASDAQ 100, there's a lot of the market that isn't functioning and still has a lot of technical damage that's been done. So as you guys can see there, we had a beautiful break following this month-long consolidation into our wave 5 targets, and the market's starting to roll over. We've had a lot of members who were looking at this move here saying, you know what, now's the time to get back in. I'm going to go full bore in the portfolio, reallocate everything. And we were pressing back on that just a little bit, trying to express some caution. Now, a lot of the driving force behind the selling pressure into the March low was the fear of the unknown. How long is the coronavirus going to last? When are we going to see a vaccine? How long are the stay-at-home orders going to remain in place? Now that we are starting to see those key metrics continue to fall off, such as the daily hospitalization and daily deaths in your key kind of hot zones such as New York, you add to that the reopening of the economy and the Fed support, and you've got a pretty good case for the March low being the end of our fourth wave correction. Now, if you guys have been following our work, you know we've been juggling two higher degree interpretations. Let's take a quick peek at those two different interpretations, and let's talk about why we do in fact believe the wave 4 completion is in. Now, going back to the credit crisis low in 2009, we have this initial motive impulsive 5-wave move. This 5-wave move was met with a period of sideways consolidation in the form of a wave 2 flat. We've had some new Ellioticians contact us and suggest that because we have this label as a flat, that it is in some way invalid. I want you guys to understand that the guideline of alternation is simply that. It's a guideline. And for those of you who are not familiar, the guideline of alternation suggests that if you have a directional correction in a wave 2 position, let's say we have a standard 5 down, 3 up, and 5 down to make up a 5-3-5 Elliott wave zigzag, then the guideline of alternation is going to suggest that you should anticipate a more sideways correction in your wave 4 of the same degree. That could be a sideways flat, it could be a sideways triangle, or even a complex. But again, at the end of the day, that's only a guideline. So given the fact that we do see flats in both of these positions, does not take away from its validity. There's another guideline that's actually playing out here that I want you guys to take note of, and that is the guideline that suggests corrections of the same degree will often tend towards equality. That being equality in either duration or magnitude, or sometimes both. So, for instance, our cycle degree wave 2 correction, which unfolded between May of 2010 and October of 2011, was exactly, or just about a week away from being exactly the amount of time that it took us to consolidate between the September 2018 high and the March of 2020 low. We have 3 down of A, we have 3 back in C, or of B, C of B, and then this motive impulsive 5-wave break lower in our C-wave position. That completed wave 4 just beyond equality of time elapsed in wave 2. Really rather remarkable. Another piece of information to take away here. The verticality to this market advance, the move that we've seen off the low, is really a bit obnoxious, right? This is a level of verticality, or in aviation we call it an angle of attack, that is simply unsustainable. You add to that unknowns going to the next couple of quarters when it comes to corporate earnings, and you've got a case for this near-term correction. Taking a step back, off the March low, our motive impulsive 5-wave move met with sideways correction gave us a spot-on textbook cycle degree third wave. Oftentimes your wave 3 is a 1.618 multiple, or 161.8% of the wave 1 projected from your wave 2. 161.8% of wave 1 projected from 2 would have forecasted wave 3 to complete at 2845 spot 93, which was really, in indices terms, a stone's throw away from the 2940 spot 91 actual intraday high that we had in the third wave. Whoops, we don't want to do that. So, getting you guys off the weekly, let's go ahead and take a look at the daily chart, and let's talk about price action off the March low. Off of the March low, we are viewing this entire sequence as a primary degree wave 1, which is now putting us into a wave 2 correction. Our wave 2 support zone is fairly wide. As you guys know, wave 2s can be very sharp. Wave 2s are designed to shake out everybody who got on board throughout this move. Okay? And really, when it comes down to the psychology of this entire correction that we saw off the top and now back here into the upside move, a lot of people who did take profits, or in fact just get out of their portfolio regardless if it was for a profit or a loss, anticipating this move to continue lower, was viewing this entire move back as a counter trend correction. Once we broke through this 3-wave structure, it became pretty clear that the move we were seeing is motive and reestablishing our higher degree uptrend. Unfortunately, retail investors have a tendency to get in exactly the wrong times, and I can't tell you how many friends that contacted me here looking to exit contacted me here saying, this is the start of a new massive bull market and we need to be on board and I can't miss this, we've got to be there. And that's exactly when, as you can see, Wall Street setting in and starting to roll the markets lower and see that trend reversal. So traders, we do expect this wave 2 correction to last through the end of July, perhaps even early August. Support zone is fairly wide. We have the area of the previous fourth, which is around 2750, but this wave 2 could really be as great as a 78.6% retracement of the wave 1 advance. That would take us down to around 2380, call it 2400 in the S&P. We are actually targeting a little bit more shallow of a move, at least to 2800, to give us a nice completed 3-wave structure here in the wave 2 position. Now I want to take a minute and address an alternate count, and I want to address the reasons why we did not favor this count. This is an alternate count which suggests we're in a 1-2, 1-2, 1-2 market, and we're just going to keep exploding higher in this ridiculous angle of attack that the markets are ascending in. Now let's just erase all of this. And a lot of people have a tendency to call that 1, call this 2. We're now in wave 3. Maybe this is a 1-2 of wave 3. Okay. This count that you're looking at here is not valid, and I want to show you why this is not valid. Elliott wave is fractal in nature, meaning you have smaller substructures making up a higher degree parent wave. So child wave, parent wave. 5-wave move completes wave 1 of a higher degree. This being an intermediate 5-wave move completes primary degree wave 1. Okay? Your higher degree corrections are of a greater magnitude. So for instance, you would not have a cycle degree 1, 2, 3, 4. Let's call this, whoops, I didn't like this at all. just trying to use it as an example mode of wave. Work with me. So you wouldn't have something, let's say, like this, where we have a short little wave 2 here and a massive wave 2 here. And the rule is net percent retracement, not retracement relative to its advance. So for instance, we have that being a 6.3% correction, while this is a 7.18% correction. That's the largest net percent correction, with the exception of this move here today, which is getting ready to surpass that. Okay, that right here is your largest net percent correction, which is your wave 2 position. So the only way for this to be a 1-2-1-2, this is not valid, as this is a smaller correction. The only way to accomplish that is to call this 1-2-1-2-1-2. Okay, which, as you guys know, if you've been practicing the wave principle, 1-2-1-2-1-2s are pretty rare. So let's talk about, and I want to show you guys a couple of the tools and the tricks and some of the signs that we saw going into this wave 5 top, which kind of filled in the picture and gave us the targeted wave 2 correction. Okay, I'm going to take you guys into the market internals, and we typically don't look at market internals, but in this case we're actually looking at the put call ratio inverted. So we essentially have the call put ratio down here at the bottom, and then we have the S&P 500 in purple. This is a chart we put out to our members, kind of highlighting a little bit of a cautionary tale as the markets were seeing this kind of irrational exuberance, you could almost call it, into this this Disneyland kind of a high, right? I heard a joke on CNBC that the Fed came in to fix a mild liquidity issue, and they ended up creating a water park. Well, boy, isn't that true. So taking a look at the purple S&P line here, and taking a look at our call put ratio at the bottom. Oftentimes you'll see extremes in either call buying or put buying being associated with reversal points in the market. So here we have the September 2018 high, and we have this peak in call buying activity. This sideways trend channel we have been following on the S&P daily chart for quite some time. This green line represents a 9-day average, 9-day moving average of the call put ratio. So we have an extreme in call buying as we print a high in the market. We then have a 3-wave move lower into the December 2018 lows. We had technically oversold conditions, and what did we have? We had an extreme in put buying. Okay, an extreme in put buying. Fast forward to our most recent market highs. Here's the January going into February high. The market establishes a new high here. As call buying reaches an extreme, call buying kind of fades away as the market consolidates. The market sets a new high. Call buying sets a lower high, and then we have this COVID-19 sell-off. From there, we were noting the fact that we were about to set a new extreme in call buying while the markets were still quite a ways from the old all-time highs. Now, let's take a look at what other indications that we have been utilizing to our advantage. We're now going to take a look at percent of stocks, or the percentage of stocks that are above their 50-day moving average. We're going back to the December 2018 low. So taking you back to that market internal, just so it kind of puts things into perspective, here's our December of 2018 low. And here, I'm going to line it up perfectly, so we're going to bring it up right over that. Here are 5.5% of stocks at the December 2018 low were above their 50-day moving average. The market then presses higher in our A wave. We consolidate in the form of a B wave triangle. Here's our consolidation phase. Then the market presses into a new high in February of 20, and only 74% of stocks were above their 50-day. So we have divergence here, and we had this very bearish divergence on our, in this case, call put ratio. So when you take that, combine combined with the signs that we were seeing in the Forex market, many of the sentiment indicating pairs were also giving us signs of a near-term top in equities. Let's take a look at some individual sectors. Communication sector ETF, which was kind of a spin-off in January of 2018. This was actually one of the charts which we utilized to help substantiate our March low. We're now using this chart along with the market internals and along with what we're seeing from a cross-market analysis basis and on a macro standpoint to kind of illustrate this overextension and identify why we felt the markets were overbought and nearing a correction. So off the March low in the XLC, communication sector, SPDR ETF, we have an initial 1-2, an extended third wave with a nice, clear, discernible 5-wave structure. Our wave 3 was just shy of our 1-6-1-8 objective. Our wave 4 was equal to wave 2 in terms of magnitude, or just shy thereof, and also met the guideline of alternation. We have a 3-wave flat here and a directional zigzag here. What did we just look at in the S&P? We looked at the fact that when you have that extended third wave, you often have a wave 5 that's equal to wave 1. In this particular case, equality of waves 5 as compared to wave 1 for the XLC sector SPDR communication ETF came in at 56.73. The high was 56.80, and we're now rolling over. Another chart, consumer discretionary. Consumer discretionary is typically one of 3 key bull market sectors: discretionary, tech, and financials. Obviously, we're not seeing participation in financials for obvious reasons. Tech, discretionary, however, have been doing well. So the XLY, again, off of our March low, we have an initial 1-2, nice extended 5-wave move in 3, a beautiful measured move correction, and where we have equality of C as compared to wave A, and we then press higher in this wave 5 position, coming just shy of 5v1 equality, but into a 61.8% when looking at wave 5 as compared to 1 plus that 4th wave correction. So we have market internals, we have Forex, we have individual sector chart analysis, all supporting that correction to the downside. So over to the S&P, we'll wrap it up here, guys. On the weekly chart, when taking into consideration time elapsed in wave 5 as compared to wave 1, as well as the magnitude, we can very quickly draw a line to take into consideration the angle of ascent, project it from that wave for completion, and as you guys can see, all we're looking for is a nice resumption to a normal, more sustainable uptrend. Off the weekly, back to the daily, we're looking for this wave 2 to carry us to at least 2750 to 2800 into the end of July, early August. So traders, be safe, be patient, await confirmation, focus on risk management, and the rest will work itself out. Thank you once again for tuning in. If you're interested in more of what we do at Trading Analysis, you can visit our website, tradinganalysis.com. Be sure to subscribe to our YouTube channel and turn on notifications if you're interested in following along with the content that we post. And I hope to see you guys on the next video update. Take care.